Okay, come on. So we're now ready to start. Okay, now, so the title which I usually assign to this webinar is called F9 MCQ session. Okay. So basically the title we give to this session is called F9 MCQ session, MCQ webinar. And I think this is the fourth or fifth time I am doing this MCQ, okay, session. I did this in previous attempts as well. Okay, so what I was saying is that I have been conducting this webinar session since last 3 or 4 attempts. And let me tell you quickly what the objective of this particular session is. Okay, the objective of this particular session is basically that you all have, I'm sure tomorrow is the exam. So all of you have their preparation. Okay, you cannot expect that's a childish attitude that someone is going to come one night before the exam and tell you how to do section A, how to do section B, how to do section C, and you will be able to go in the exam and ace the exam. That's not like that, right? This webinar is just a quick revision webinar targeting an area which everyone feels uncomfortable with in a financial management exam. Okay, and that is the area of MCQs. Okay, now what is the problem with the MCQ area? Like if we talk about section C of the syllabus, where you have 2 long questions. We talk about section C of the syllabus where you have 2 long questions. It's quite predictable and comparatively easy as far as student feedback is concerned, because I've been teaching this exam FM together with F8 audit and assurance, together with F5 performance management, together with AFM since the last 10 or 12 years. Now, these 2 long questions are quite predictable. Okay, predictable in the sense means that you know that one question is going to come from investment appraisal, and people are usually very comfortable with the investment appraisal. Okay, and the other one is either WACC capital structure or working capital. So, okay, we are comparatively fine with that particular area as well. Okay, section C. I have never seen any students complain that we were finding difficulties in section C. Okay. Now, if you move to section B, that is MTQ section. That's also quite predictable. You're going to get 3 MTQs. We all know that 1 MTQ is going to be from risk management. Okay, 1 MTQ comes from risk management. Fair enough. Okay. Then we all know 1 MTQ is going to come from business valuation. Risk management means currency risk, interest rate risk, the forwards, futures, the business valuation, net assets valuation method. So it comes from business valuation. And 3 is not that predictable, but still 2 MTQs out of 3 are known. Quite easy. I haven't seen any student worrying too much about section B. Now comes section A. In section A, you have 15 MCQs, right? In section A, you have 15 MCQs. About this 15 MCQs, when a student asks the tutor or we ask the examiner that from where this 15 MCQs will come, so an answer is provided. It's from across the syllabus. And across the syllabus obviously is a very dangerous term, because across the syllabus means that MCQs come from anywhere. And the way majority students study, so to find difficulty in covering every area of the text and every area of the kit. So this is always an area where examiners say that the performance is bad. They don't say about this in section C, the long question. They don't say about this in MTQs, but here they say performance is bad. Plus the other issue that ACCA examination team does not publish the MCQs after the exam. They publish the long questions, but they don't publish this particular issues. So it is a thing which creates some problem for different students. So that's why this particular session is created by me one day before the exam, in which we solve few MCQ questions, and those MCQs have been extracted by me from different sources. And based on my trend analysis, I personally feel that these get tested often, and my trend analysis say you might face them in the exam as well. Now, whenever I have conducted this MCQ session, after the MCQ session, students, obviously we have made a WhatsApp group, and students usually say from this WhatsApp group that tomorrow when the exam comes, students say that we got 3 questions from there. We got 4 questions from your session. We got 1 question from your session. We got 2 questions from your session. So no matter if you're just taking a 1.5 hour session and you're able to get lucky 3 MCQs in the exam and getting 6 marks as it is from this, I think that's really fine. Now, this is my analysis, my thing that I personally believe that, and you should not take as an obligation, because this is not a paid session. When we take paid session, it's an obligation that you have to do everything, and you are liable to something. Obviously, it's a complimentary session, and the objective is to help students around the world. So if not a single question comes, obviously You should not say, oh, our 1 hour was wasted. Obviously, you did 10, 12 MCQs in that 1 hour, which you weren't able to do that in the previous time, and new MCQ as well. So make sure it's no obligation, no liability, is just a helpful session for all of you. Okay, because it's a tendency, especially from few of the students, like I have just received a message in the chat box. Your net is very problematic. Oh my God. Dear, if my net is problematic, why are other people here? So you should write my net is problematic, but our tendency is that always shift the responsibility on the other party. Okay, I've been seeing this for the last 10, 15 years. That's quite acceptable. But let's just start. I am opening a file, and don't start asking me from this file, because after the class, I will share this file on the group. Okay, so just a second. Okay, so let's start with first these MCQs, which are on the screen. I'm muting the WhatsApp group because people are constantly disturbing others there, and we will open it after the session, okay? We will start with question number 18, MCQ number 18. A company that has a $10 million loan with a variable rate of interest has acquired a forward rate agreement with a financial institution that offered a 3-6, 3.2% 2.7% spread. What would be the payment made to the financial institution under the terms of FRA if actual rate of interest was 3%? I would just request people, there is so much disturbance and problems with messages. Let's just wait. We have started with question number 18 first. So whether we will get recording, whether please send the WhatsApp group link again, blah, blah, blah. Please, you need to have some patience. Don't use the chat box. Please don't use the chat box unless you have a question related query. I repeatedly said in the opening portion of the class that the session will be recorded. You will get recording. Everything has been told. Please have some patience. Let me just start the work. We're not able to start the work just. Okay, so MCQ number 18 first. A company that has a $10 million loan with a variable rate of interest has acquired a forward rate agreement with a financial institution that offered a 3-6, 3.2% 2.7% spread. What would be the payment made to the financial institution under the terms of FRA if actual rate of interest was 3% to the nearest dollar? Now, let's just give you a quick recap about FRA. You all know that FRA stands for forward rate agreements. FRA stands for forward rate agreements. Okay. Now, in forward rate agreements, if we say it's, let's suppose, 2-6. So we all know 2-6 means it starts in 2 months and lasts for 4 months. You know, this is the principle of FRA. Or if FRA is, let's suppose, 5-7. So it's going to start in 5 months and last for the gap 2 months. The gap is reflecting the difference. Okay. Now it states a company that has a $10 million loan with a variable rate of interest has acquired an FRA with a financial institution which has offered a 3-6. 3-6 means start in 3 months and last for the gap 3 months. 3.2% 2.7% spread. Now, what does this 3.2% and 2.7% means? Whenever two currency rates are given, one is the buying rate, one is the selling rate. Whenever two interest rates are given, one is the borrowing rate, one is the deposit rate. And always remember, the lower is the deposit rate and higher is the borrowing rate. That's a general principle in banking industry. Higher rate is the borrowing rate. You borrow at a higher rate and you deposit at a lower rate. Because if it's vice versa, you deposit at a higher rate, borrow at a lower rate, you will borrow from the bank at lower rate and deposit at higher rate and make money. That's not possible. Higher rate is always the borrowing rate and lower is always the deposit rate. Okay. What would be the payment made to the financial institution under the terms of FRA if actual rate of interest was 3%? How is the payment made to the financial institution? Now, let me tell you the solution of this. Now the FRA is 3-6, right? It starts in 3 months and lasts for 3 months. Okay. Company has 10 million loan, right? And has acquired FRA. Company has a 10 million loan and has acquired FRA. 3-6. So start in 3 months and last for 3 months, right? At what rate? There are 2 rates given, but it's a loan, right? Company has a loan, so it's borrowing rate, right? 3.2%. So company has a 10 million loan, acquired FRA, 3-6, start in 3 months, last for 3 months at 3.2%. Okay. This means Forward rate agreement has loan, 10 million loan, acquired FRA, forward rate agreement, 3-6 at 3.2%. This means FRA, forward rate agreement, locks interest. Forward rate agreement means it's a rate fixation contract. Forward rate agreement means it's a rate fixation contract. So it's locks interest. $10 million loan, you did FRA, forward rate agreement, so your interest rate is locked at 3.2%. But this 10 million loan, your interest rate is locked at 3.2%. If you multiply 10 million with 3.2%, that's per annum. You need only for 3 months. 3-6 means you only need it for 3 months. Okay, so let's just count the interest. 10 million, 3.2%, 3 by 12. $80,000. Okay, company has a 10 million loan. It has acquired an FRA, forward rate agreement, with an institution, 3-6 for 3 months at 3.2%, that's 2.7% spread. So lower it is the deposit, higher is the borrowing. You are taking a loan, it's a borrowing rate. So company has 10 million loan, acquired FRA, 3-6 at 3.2%. Acquiring FRA means interest is locked. 10 million, 3.2% lock rate into 3 months, 80,000 is the interest locked. Now the requirement is what would be the payment made to the financial institution under the terms of FRA if actual rate of interest was 3%. Now, if actual interest rate is 3%, if actual interest rate is 3%, the requirement is what would be the payment made to the financial institution if actual interest rate is 3%. If actual interest rate is 3%, actual interest cost would have been, if actual interest rate is 3%, actual interest cost would have been 10 million loan, 3% for 3 months. $75,000. If actual rate is 3%, the actual interest cost would have been 10 million loan, 3% interest, 3 months, 75,000. But you locked an FRA. And an FRA, you locked the rate at 3.2%, you locked the payment at 80,000. So actual interest cost was 75,000, but you locked the rate at 80,000. So what would be the payment made to the financial institution? The interest cost would have been 75, but you locked at 80. So interest to the financial institution who offered you the FRA should be 5,000. This 5,000 is the correct answer. You can quickly note this, and if you have any queries, you can ask me now in the chat box, and then we'll proceed further. Advait, we will take all questions. Okay, don't worry. Yes, inshallah, we pay 5,000 extra. Yusuf, 3-6 means the gap is the loan period, that we take loan period as 3 months. If it's 5-7, we take for 2 months. Imran, the scenario is that we locked the interest cost at 3.2%, that we committed to pay 80,000, but the rate of interest was 3%, so your interest cost would be 75,000. That means you have to pay extra 5,000. Now, had the requirement been that the interest rate is someone is asking 4%, you can calculate it. That if the interest cost is 4%, 10 million into 4% into 3 by 12, our interest cost would have been 100,000. Okay, so interest cost would have been 100,000, but we committed 80,000. We locked the rate at 80,000. So now the financial institution will pay us 20,000. Yes, Haris, that's what hedging is, that you only pay the difference. In hedging, you never pay the full amount. That's why you are hedging. Now, if the interest rate becomes 3.5%, okay, so your interest cost would be 3.5% of 10 million into 3 by 12. It's 87,500, but you committed 80,000 with the financial institution. So financial institution would pay you back 7,500. However, if the rate is less, 3%, but you committed 3.2, you have to pay him, okay? Yes, if interest rate you locked at 3.2%, it's a simple formula. You lock the interest rate at 3.2 with the financial institution, that you will pay 3.2%. Now, if the interest cost is more, you are protected, you have hedged, you lock the rate, the financial institution will pay you. But if the interest cost is less, you committed more, you have to pay. That's what gain or loss is in FRA. Okay, now let's move forward towards question number 17 now. Which two of the following statements? Now, always remember such type of MCQs, which two of the following statements, asking two statements about overcapitalization and overtrading are true. Overtrading arises from a rapid increase in revenue. Overcapitalization results in relatively low current ratio. Overtrading may result in relatively high accounts payable, and overcapitalization is the result of too much short-term capital. So what we will do about this? Which two of the following statements about overcapitalization and overtrading are true? Now remember, overcapitalization when there is too much investment in current assets, okay? And overtrading when you try to do too much too quickly. Overtrading has basically four indicators: high increase in revenue, high increase in overdraft, fall in current ratio, quick ratio, and the worsening of inventory receivables payable days. So option A, overtrading arises from a rapid increase in revenue. Yes, overtrading has a symptom, high increase in revenue. So option A seems correct. Overcapitalization results in low current ratio. That's wrong, right? Why? Overcapitalization means more investment in current assets. So this will lead to a high current ratio, not low current ratio. Overtrading may result in relatively high accounts payable period. Yes, worsening of inventory receivable payable days. So high accounts payable turnover period means it's worsening. Overcapitalization is the result of too much short-term capital. Wrong. So the correct answer of this is going to be A and C. Please do this file completely, because you're going to find few MCQs in your tomorrow's exam maybe from this, okay? Now, I received 5 answers of this question number 17 in my chat box, and all of them were incorrect. The reason is that reading the question and just jumping to the conclusion, that's wrong. Patiently, first with patience, read the requirement, try to recall the stuff, and then give the answer. Okay, MCQ number 16 now. Which two of the following is the correct description of the net working capital? There was a typing error, I apologize. Okay, which of the following is the description of net working capital? Again, I have received 3 answers saying option A. Please read the requirement. It's saying which 2 of the following. What image you are portraying to the examiner if I'm the marker? See, you are not reading the question properly. It has clearly asked you there are 5 students saying A. How can you answer this? It has clearly said which 2 of the following. So why aren't you saying 2? I receive one answer D. How can it be? You have to say 2. So which 2 of the following is the correct description of working capital? So we have always studied working capital is the amount required in day-to-day operations, normally classed as the excess of current assets over current liabilities. It's current assets minus current liabilities. So A is definitely correct. Inventory days less receivable days, no. There is nothing in working capital regarding days. Current assets over current liabilities, that's the formula of current ratio. Now the only left is D. Yes, the long-term capital invested in net current assets. Net current assets means after deducting liabilities. That's what working capital is, the capital tied in day-to-day operations, net assets. Okay. So 16 is basically A and D. Omar, A and D means option A and D. Okay, question number 15. A project has average estimated cash flows of 3,000 per year with an initial investment of 9,000. Depreciation is straight line with a no residual value and the project has a 5-year lifespan. The company has a target ROCE of 15%. Okay, point to be noted, target ROCE of 15% and target payback of 25 years. ROCE is based on initial investment. Now, you know, there are 2 formulas of ROCE. Average profit over average investment and average profit over initial investment. Okay, there are 2 formulas of ROCE, average profit over average investment, average profit over initial investment. Both of these formulas are mentioned in Kaplan study text, but if examiner doesn't say anything, you can use any formula. If he says based on average investment, divided with average investment. If he says based on initial investment, use initial investment. Okay. So project has an estimated cash flow of 3,000 per year. Initial investment is 9,000. Depreciation straight line with no residual value. Company has a target ROCE of 15% and target payback of 25 years. ROCE is based on initial investment. Under which appraisal methods using the company's targets will the project be accepted? So you know the rule of NPV. In NPV, we accept project when NPV is positive, and under ROCE, we accept the project if it exceeds the target ROCE. Under payback period, we accept when it is less than the target payback. Okay, there are 4 investment appraisal techniques: NPV, IRR, ROCE, payback. The rule of NPV is positive accept, negative reject. The rule of IRR is it must exceed cost of capital. The payback rule is it must exceeds the target, it must be less than the target payback, and the ROS is must exceed target ROS. So under which appraisal methods will the project be accepted, ROS or payback? So we need to find ROS, we need to find payback. Now the formula of ROS is average profit over initial investment in 200, because it's stated that ROS is based on initial investment. So average profit over initial investment. Okay. Now, how is average profit computed? How is average profit computed? Average profit is the total cash flows. Okay, total cash flows are 3,000 per year, 5-year lifespan, 15,000. This is the total cash flows less total depreciation. So depreciation is 9,000 over life, that is 5 years. This is the formula of average profit. Total profits, cash flows, less total depreciation, which is 9,000, the whole investment cost, over life. So this is the average profit over initial investment. Initial investment is 9,000 into 100. So 1,200 divided by 9,000 into 100. 13%. This is the ROS. ROS is 13%, whereas target ROS was 15%. So target ROS was 15%. That means we targeted a ROS of 15%. If it's 13%, we should reject this project from the point of view of ROS. Okay. Now, cash flow is 3,000 per year. Initial investment is 9,000. If cash flow is 3,000 per year, investment is 9,000. That means you will recover your money in 3 years. Your payback is 3 years. If 3,000 per year is the cash flow, investment is 9,000, you will recover money in 3 years. Payback is 3 years, but target was 25 years. Is the project's payback less than the target payback? Yes. So you will accept as per payback. So the answer would be payback basis, not on ROS basis. ROS basis rejected. Moab, the formula is initial cost plus scrap value over 2. Yeah. Rana, hi. I'm not able to see that. Why you are not able to see the initial investment? It's clearly written in the first line that initial investment is 9,000. Mohib and Umar, what you are saying divided by 2, that's for average investment. We are not calculating ROS based on average investment. The last point of the question clearly states ROS should be based on initial investment. So we are dividing by initial investment, not the average investment. If it's average investment, then you are correct. Okay, now question number 14. Lee Company is an all equity finance company which wishes to appraise project in a new area of activity. So we all know that new area of activity means it's a diversification case, right? Its existing equity beta is 1.2. When you're going in a new area, you might have learned in weighted average cost of capital that when you're going in a new area, the existing beta equity is irrelevant, that's 1.2. The industry average equity beta for the new business is 2. The equity beta for the new business is 2 with an average debt over debt plus equity ratio. Debt over debt plus equity ratio means that same thing. Debt, D over D plus E. So debt over total ratio is 25%. So if debt to equity ratio, debt over debt plus equity is 25%, that means the equity portion is 75%, right? If debt portion, debt over total is 25%. So from total debt plus equity, debt is 25%. So equity is going to be 75%. Risk rate of return is 5%. And risk premium is 4%. Ignoring tax and using CAPM. So ignore tax and using CAPM. Calculate a suitable risk adjusted KE for the new project. You need to find a risk adjusted KE for the new project. Now you have clearly seen the question that it's an all equity finance company which wishes to appraise project in a new area of equity. Its existing equity beta is 1.2. Company's existing beta equity is 1.2. The industry average equity beta for the new business is 2. For the new business, the equity beta of the industry is 2. And its debt over total is 25%. So equity over total is 75%, risk rate 5%, premium 4%. Ignoring tax and using CAPM, calculate a suitable risk adjusted K. So you need to find K. It's going in a new area. So the formula of K is RF plus premium, RM minus RF into beta equity. So you know the risk-free rate is 5%. The premium is 4% and beta equity. Since you are going in a new line of business, you cannot use your existing beta equity and you cannot use the proxy beta equity. You have to follow a process called ungearing and regearing. Hope you remember this stuff one day before the exam, that when you go into a new business area, you have to follow a process of ungearing and regearing. Now, what is ungearing? The equation used is beta asset is equals to beta equity into equity portion. There's no tax, therefore I am not mentioning tax, plus beta debt into debt portion. Regearing also has the same formula, beta asset is equals to beta equity into equity portion. I am not mentioning tax because the question has said ignore tax. Beta debt into that portion. Okay. Now in ungearing, we use proxy data. In ungearing, we use proxy data and try to find beta asset. Try to find beta asset. So look at proxy data, try to find beta asset. Okay. So if from proxy data, we find beta asset, proxy's beta equity is 2, equity portion is 75 over 75 plus 25. No beta that is given, so that means risk-free 0 whole bracket would be 0. This will make beta asset 1.5. This is called ungearing. Okay, regearing. Put that beta asset in your own results. In regearing, you put that beta assets in your own results. In your own results, you put beta asset 1.5 to find beta equity. And it's written, it's an all equity finance company. Your company is all equity finance. So equity portion is 100%. Your company is all equity finance, no debt portion. So it's 100%. Understanding? Because if you're all equity finance, that means it's 100% equity. No debt portion. So when you do regearing, the beta equity is going to be 1.5. You place that beta equity here, and the answer is going to be 11% for this question. Question number 14. I didn't have space, so I did it here. Okay. Please copy this, and you can ask any questions. Okay, why is beta debt 0 here? Beta debt is given in the question, and if it's not given, that means debts are risk-free. You always take it 0. So if it's given, fine. Not given, always take it 0. Can you please explain again the 100% of equity part? In the first line of the question, it's written that our company is all equity financed. All equity finance means you have no debt. So equity portion is 100%. Tamur, we found beta asset, then we put it in our own results. We did regearing to get beta equity, and it's coming the same because equity is 100%. Yes, inshallah, the formula will be given. Advait, you can check 1.5 is beta asset, and when we regear it at the right side, it's beta equity. Mohammed, in place of D, we write 1 minus T as well. Advait, it's not possible to get 2, it's 1.5. Please use the calculator. Yes, Miraj. Miraj, the formula sheet is given in the exam and on the first page of the book as well. You can refer to that because we don't need to spend time here. The thing is given in part of D, in place in front of D, we write 1 minus D everywhere. Okay, come to question number 13 now. Question number 13 states for the coming year, a company has budgeted sales of 2 million, 80% of which will be on credit. It expects its account receivable payment period to be 3 months. Now, accounts receivable payment period is 3 months. Okay. This is the receivable days. Receivable days are 3 months. Forecast average inventory and payable days are, forecast for average inventory and average accounts payable are 10 million and 4 million. What is the company's working capital requirement? It's asking company's working capital requirement. Now remember, working capital is current assets minus current liabilities. Working capital is current assets minus current liabilities. In current assets comes inventory, receivables. In current liabilities comes payables. Okay, so current liabilities are payables. That's 4 million. Okay, and current assets include inventory, receivables. Okay, so you have inventory of 10 million. Receivables. You have got receivable days. So from the formula of receivable days, which is receivables over credit sales into 365 or 12 months, you can find receivables. Okay, so receivable days are 3 months. We need to find receivables, and since we have placed 12 months for the whole year, we should take whole year sales. So sales are 2 million per month. So for the whole year, it's 24 million and 80% are credits. So it's 19.2. 3 into 19.2 divided by 12. Receivables are 4.8 million. Okay, so 4.8 plus 10, 14.8 is current assets less current liabilities, 4 million. The answer is 10.8 for working capital. Now this was quite easy because working capital is basically current assets minus current liabilities, right? So current assets include inventory, receivables, and if cash is given, we take that as well. Current liabilities include payables, overdraft. Only payables was given 4 million. In current assets, we take inventory, receivables. So inventory was given. Receivables we found through receivable days, reverse working, and that was it. We took multiply by 12. So Supreet Kaur, we took multiply by 12. That means we took for 12 months. So the credit sales should also be of 12 months. 2 million is the monthly sales. We need to multiply by 12 to get annual sales and then multiplied by the credit portion, 80%. Yes, Omar, it means 40%. So Motashim, that's what I've been saying for 3 times. 2 million, 80% is 1.6. That's for 1 month. Read the question carefully. It's monthly sales. So you need to multiply it with 12. Question number 12 was right from the study text. Which two of the following instruments are characterized by standard contract size? Remember, only 2 instruments are standardized. One is futures and one is options. C and F would be the answer. One is futures, one is options. After many messages, I have shared the WhatsApp group link again. Over the counter means that you can have it tailor-made as per your own. An exchange tradable option means it's standardized. You cannot tailor it as per your own. Okay, question number 11, it's from working capital management. The inventory ordering policy of ZAR companies to order 100,000 units when inventory level falls to 20,000 units. So listen carefully, the inventory ordering policy, its inventory ordering policy is to order 100,000 units. The inventory ordering policy is to order 100,000 units. You order 100,000 units when inventory level falls to 20,000 units. Okay. The cost of placing and processing an order is 200 ordering cost, while the cost of holding inventory is 0.5 per unit per year. Orders are received 1 week after being placed with the supplier. Orders are received 1 week after being placed with the supplier. Production requirement for next year, 50 weeks, is 600,000 units. So next year, the production requirement is 600,000 units for 50 weeks. That means 12,000 units required per week. Okay. We haven't yet read the requirement. We are just working around some stuff. That inventory ordering policy is to order 100,000 units. Your policy is to order 100,000 units when inventory level falls to 20,000 units, when you have 20,000 units left. Cost of placing and processing an order is 200. This is the ordering cost, that's 200, while the cost of holding inventory is 0.5 per unit per year. Orders are received 1 week after being placed with the supplier. So when you place order with the supplier, you receive them after 1 week. Production requirement for the next year, 50 weeks, is 600,000 units. So 600,000 units is the production requirement for 50 weeks. That means it's 12,000 units per week. What is the cost of ZAR company's inventory ordering policy? So it's asking what is the cost of ZAR company's inventory ordering policy. Now, the cost of ZAR company's inventory ordering policy. Remember, if you know working capital management, the cost of inventory ordering policy is made up of 3 things. Total purchase cost, which is purchase price per unit into annual demand. Total ordering cost, that's C0, ordering cost per unit into number of orders, what's annual demand over order size. Okay, number of orders is annual demand over order size, and total holding cost, that's CH into average stock. And average stock is basically buffer stock or safety stock plus half of order size. If you just remember the formulas, that's easy. Inventory ordering policy cost is required. What is the cost of ZAR company's inventory ordering policy? The cost of inventory ordering policy is made up of 3 things: purchase cost, ordering cost, and holding cost. Purchase cost is purchase price per unit into annual demand. Ordering cost is C0 into number of orders, that's annual demand over order size, and holding cost is CH into average stock, which is buffer stock plus half order size. Now let's start. Once you find 3 things, add them up. That's the total cost of inventory ordering policy. Purchase cost, purchase price per unit into annual demand. Now you have annual demand with you, 600,000. You have annual demand with you, 600,000 units, into purchase price per unit. That's not given. Nowhere in the question I'm able to find purchase price per unit. So it's not possible to calculate. People start worrying, how will I calculate? Oh my God, I'm writing, it's not possible to calculate. Oh, data is not given, you cannot calculate it. Okay. Total ordering cost, C0 into number of orders. Number of orders is annual demand over order size. So C0 is the ordering cost per order. So ordering cost per order is 200 into annual demand over order size. Annual demand is 600,000 and order size is 100,000. Remember the first line? The inventory ordering policy is to order 100,000 units. You're ordering 100,000 units. Order size is 100,000. So 600,000 annual demand, order size 100,000. 6 orders into 200. It's 1200. Holding cost, CH into average stock. CH is the holding cost per unit, 0.5 average stock. Buffer stock plus half order size. Half order size. Order size is 100,000. The first line is written, order size is 100,000. What is the buffer stock company is keeping? Now listen to this carefully. That was the only technical thing in this MCQ. Now, the inventory policy is to order 100,000 units. Policy is to order 100,000 units. You order 100,000 units. When inventory level falls to 20,000 units, that means the lowest inventory you keep is 20,000 units. You place an order of 100,000 units when the inventory level is 20,000. Always you have 20,000. Then you place an order, and orders are received 1 week after being placed. So you keep 20,000 when you order, and the order is received 1 week later. In 1 week, 12,000 units is used. So that means every time you always have 8,000 in stock. That's the buffer stock. I am repeating it again. Please pay attention. This is going to make it 8,000 plus half of 100,000, 58,000. But I am repeating this 8,000 again. You place order of 100,000 when inventory level falls to 20,000 units. You always have 20,000 units in stock. Then you place order. And when you place order, it's received 1 week later. So 20,000 you ordered, and order received 1 week later. In 1 week, you use 12,000 units. So 20,000 at the time, 20,000 you place order, and it's received 1 week later. You use 12,000 in that 1 week. That means 8,000 is always in stock. That's buffer stock. 58,000 into 0.5. That's 29,000. And 29,000 plus 1,200, it's 30,200. Okay, please copy it. Imad, it's clearly written 600,000 units is the production requirement for 50 weeks. So 12,000 is per week. I think you should take 2 minutes to copy this. I will repeat it again, okay? Okay, buffer stock or safety stock is the minimum stock which is always kept with you. So listen to the first line before understanding this and the last line. The last line is production requirement is 600,000 units for 50 weeks. So 600,000 units is the production requirement for 50 weeks. That means weekly requirement is 12,000 units. Okay, you should understand 12,000, we use it per week. Now look at your inventory ordering policy. You order 100,000 units when inventory falls to 20,000 units. So when 20,000 units is there, you place an order. Now 20,000 units is there when you place an order. You place an order of 100,000 units when inventory level falls to 20,000 units. When it's 20,000 units, you place an order. An order is received 1 week later. So you place order on 20,000 units and it's received 1 week later. In that 1 week, you will be using 12,000. So when the new order arrives, you will always have 8,000 units in stock. That's your buffer stock. Okay. Now, we have discussed it till question number 11 of this. Now I will be ending this on this, and once it ends, within 10-15 minutes, I will share with you a video on the group in which the first 10 MCQs will be solved, the first 10 from 1 to 10. These are very, very high priority MCQs. Question number 1 to 10, these are very high priority MCQs, plus this 11 to 18. You should, before going to the examination, constantly revise all these 18, maybe 2, maybe 3, maybe 4, you will get it in the exam. And this will help you to score 4 or 5 easy marks by just investing few minutes of yours or few hours of yours, okay? And on the group, I will be changing the settings now to open. And if you have any queries, you can ask from me privately and stuff, because the objective is to help you before the exam as much as possible, okay? Thank you very much. Take care.